Welcome to the fourth quarter update for the retail segment at Greenleaf. Today, we're going to cover everything that's happening in our retail portfolio, along with touching base on what we're seeing in the retail market. So we have Andrew and myself today, ready to get started and go into it.
Ready to talk about retail today.
Yes.
So all retail, everything retail.
So let's start out with the market as a whole. I feel like the retail market and what we've seen in it is definitely a tale of two cities. That's what's happening. Some things are going really well and some things are not going so well.
Right. There's a lot of success in the market right now, and there's a lot of I guess we call it sad stories in the news. So
Yeah.
There's a handful of sad stories.
We look at just retail stores that are closing. That's one thing that's one. If anyone ever announces that gets a ton of media attention.
Right. So the bad news always gets the news versus the good news, and there's a lot of expanding brands too, but
the bad news.
The bad news.
The bad news goes first. So.
Yes.
So we're going to start with the bad news first. That was really looking back at 2024 as a whole. We saw things like Big Lots, they're closing 400 stores. Walgreens was closing 1,200 stores. The whole CVS, Walgreens kind of corner pharmacy business model has really, it's really just imploded.
Yeah, you know what I haven't seen too? Because Amazon's supposed to get in the pharmacy business, but I haven't seen necessarily a big push for Amazon pharmacy. Have you tried that one yet? Does that even exist?
Nope. I don't know.
Yeah, because I know that was coming. But also Bed Bath & Beyond. And
I mean, even the cost plus drugs thing that Mark Cuban started is phenomenal compared to like going to a CVS in the corner.
Yeah. In fact, we buy, whenever I price a prescription now, there's the Good RX thing, which is similar to Mark Cuban's thing. And you actually, health insurance is not what it used to be. And so sometimes the health insurance is actually more expensive than doing something else or private pay.
So a lot of those retail front, you're going to hear that bad news of those stores closing. And then there was also like Family Dollar. We're invested in dollar stores, and Family Dollar said they were going to close a bunch of locations, mainly resulting from their Dollar Tree, Family Dollar
it was a bankruptcy
merger that they're going to close all the underperforming stores there.
Right, and so there's about 600 stores that are going to be closed for Dollar Tree and Family Dollar, and we have one Family Dollar, and that's it. But our Family Dollar that we own is one of the top performing Family Dollars, and so like most of the stuff we buy, anything we buy is going to always be at the top of the food chain. We're not buying the stuff at the middle or the bottom of the food chain. So just as far as the Greenleaf portfolio is concerned, we're always good just because of our strategy.
Yeah, we keep using Placer. That's one of our main sources of how is a deal performed compared to its peers. So if we're looking to buy something, we want to make sure it is a top performer, and Placer enables us to do that based on foot traffic. So it's a great resource. I feel like everyone knows about Placer, though, so everyone's looking at it. The deals that are bad, and if it says it's a bad deal on Placer, it's going to be tough.
Yeah, and we've been talking about Placer forever. People probably get sick of hearing us talk about it, but
it's just one of the main metrics that we're using.
Yeah, every day we're on Placer looking at, does this property perform better than the average unit volume, or is it worse, or where is it on the pipeline? So when we're looking at a Dollar General, which we look at a lot of, there's 16 or 17,000. Actually, there's 18,000 now. Definitely over 17,000. And so we look at where it is in the line of 17,000 and nationally in the state and actually in the 50-mile radius, and we make sure it's always in the top 60th percent. It would be top 40th percentile of performance by foot traffic, and we only focus on those top performing ones.
So one of the things that's interesting that we are seeing in the market right now that's exciting, really the exciting part of it to talk about, is there's a lot of adaptive reuse of retail space that's happening because you have all these big stores that are leaving. It's kind of like, okay, what's going to go in there and figure it out? It's been everything from, it's more, I would say, things you're going to go do versus pure retail.
Go ahead, say it. Say it, Dave.
It's going to be pickleball.
It's going to be pickleball. Yes, it's going to be pickleball.
Like everyone's like, how many pickleball courts can you fit in that space? That's one that's big. But also just here in Atlanta, we've got, there's indoor mini golf stuff that has picked up and is pretty popular.
I would be a bigger fan of mini golf than pickleball. Or even, what's really fun?
They're both pretty fun. But it's an experience. You're going for, instead of an old retail shopping experience, you're going for do something hangout experience.
But the super fancy indoor putt things, those are...
Putt shack is pretty cool.
Putt shack is pretty cool, It's really cool.
So most of that, it feels and looks like adaptive retail reuse of the space that's there.
Yeah.
So that stuff that's exciting that's happening, that's not, you're not going to open 1,200 putt courses in a town to replace, all the Walgreens and CVS's there. I guess there's 1,200
Yeah,
nationally,
but even like in Dunwoody, which is a pretty good retail market, although we probably have too much retail, the Walmart closed, and so that's a huge deal too. And so what's going to happen? Everybody's talking about what's going to happen in the Walmart in Dunwoody because it was a super Walmart, and those are like I think 80,000, 100,000 square foot spaces.
yeah,
Those are gigantic spaces, and obviously it's going to turn into
it'll be
something.
something. It's a great location though.
Yeah, yeah, yeah.
So,
But there's also an argument
but
that sometimes there's saturation, and sometimes there's too much retail for the population, and so you kind of have to figure out that balance when there's too much.
but overall, I mean, that kind of like older retail stuff that really didn't adapt, didn't modify their business plans, is going to the side, and you're seeing that impact. And it'll be exciting to see the kind of the new stuff that takes its place.
Yeah, like certain sectors, like of course, there's always the mall conversation, but traditional footprint retailers that have not adapted to an online strategy, like Macy's and Nordstrom and Foot Locker, they're not, they're not,
Yeah, like they
they're
have
not
something
winning.
online, but they're not winning it.
They're not winning.
So,
Yeah, they're
but
definitely not
malls,
winning.
I went to the Mall of Georgia this weekend. It was slammed.
Certain
Packed.
malls,
Like
certain,
certain malls and certain retail are doing
yes,
really well,
yes, yes.
and then the other stuff is doing really bad.
Then it's back to location, location,
But I think
location.
that's every business cycle when you look at performers, how they perform over time, and it ebbs and flows. So,
Yeah. Well,
um,
you
but
know, even the Dunwoody Mall, the Perimeter Mall is one of the. It's doing great. It's thriving. It's always busy, and they have their share of problems. The Dunwoody police tell me about how they it's a frequent flyer, so they have a
yeah,
lot of visits.
there's always something. But
But there's winners too now. There's winners that are actually growing. So some of the winners are like Costco is winning. I'm a big Costco fan. Costco sales.
yeah, I mean that's retail. Their sales are up 5% in 2024.
Yeah, and I'm at Costco spending a lot of money
You're
pretty much
you're
every
helping with that
weekend.
trend.
Yes, in fact, I finally told my wife you can't go to Costco with me anymore because she just wants to zip through it, and I want to look around and buy stuff I don't need. And then, of course, like the eyeglass place, Warby Parker. For the first time, I bought my kids' glasses at Warby Parker in the mall. So
Yeah.
the mall actually caught me going in there and buying something.
There you go.
So I haven't done that in a long time. And then I know you're a frequent flyer of this one, but Ulta Beauty is also doing pretty well.
I have a little girl, so
So you know
familiar.
that one. Okay.
Yes.
All right. So those are some winners.
There's definitely retail that is doing well. So it's kind of balancing that out there and then seeing which ones is there an opportunity to do something with it. We haven't really done any adaptive reuse of kind of the box square footage. We've done it on the office side. We've done it on just kind of like the vacant building in general. Once a CVS leaves, it's more just a vacant building. You turn it into anything at that point.
And we've talked about buying
Yeah.
some CVSs and turning them into something possibly like a hardware store or something
We-
else. But like we in
We
fact,
tried to buy one here, and it turned into a Crate and Barrel outlet.
yes.
The one, so
yes, yes.
we didn't get that one. I mean, that was right in our backyard. We were hoping to do that one.
And by the way, that
but-
Crate and Barrel outlet's a pit. I've been there a couple of times. It's not
Well, I
good.
don't think they're necessarily making the nicest outlet stores.
Yes,
A
yes. yes.
one-off standalone
I'm-
outlet.
I'm getting some upsetness over here. They don't like my comment. But Walmart, like I don't know what we would do at the Walmart. Walmart's a pretty major.
We looked at
Uplift.
a vacant Walmart that was up in Chattanooga. It still had like 6 years left on the lease. They're still paying it, but it was also like, well, then what's going to happen? Because it's a good
Pickleball. Pickleball.
everywhere can be pickleball.
Everything.
All
The
right.
answer to everything is pickleball.
But other part of retail, I mean, retail is highly dependent on interest rates. We're going through our interest rate pricing. We're always talking to lenders that are out there. There is debt available, but it's in the 6.5 to low 7 range. And that, all the money when we were looking at net lease opportunities was really finding something that was at a 7 cap and you could get debt in the low 3s. You've got a good spread and you can make some money. And that opportunity was fantastic.
I mean, that's how we built our whole retail business. We were getting debt at 3.5 to 4%, and we're buying deals at a 7 and saying a 7.5 cap. And so you have a 350 to 400 point spread between the deal, and you just make money naturally because you have such a big spread between interest rate and cap rate. And now that debt came due, and so that 3.75 debt annually is now going to go to 6.75 debt. So it's a different market now.
Yeah, that certainly makes it tighter on the net lease front. But what we've also seen is just because of that, people aren't transacting as much. So there's still a lot less volume in the market. When we were looking at going into 2024, saying sales are down 60, 70%, that has really just kept pace. and there is not a lot of transactions that are happening in the market right now, mainly due to that.
Yeah.
So sellers are deciding, hey, we'll just hold this thing instead of selling it.
Yeah, and prices did move a little bit, but prices did not. I mean,
Yeah,
they moved up.
if cap rates went up half a point,
Yes, yes.
you
Cap
know,
rates moved a lot slower than interest rates. So interest rates
yeah,
might have gone up, well, three to
three
four
to
hundred
400,
points, and cap rates might have gone up 100 points. And so
yeah.
that's not enough.
And if you look at that just from a percentage standpoint, interest rates doubled
No, they
in
went up four
cost.
times, 400%,
Well,
400
they
points.
went from 3.5 to
Oh yeah,
7,
that would be double. You're right.
right?
You're right. Double.
And then, but cap rates only went up 50 points from 7%.
Yeah,
So
not even 10%.
it's way out of whack on that. So it makes the retail space very tight right now from a transaction side. So deal progress still fairly slow. We found a couple this year, but it has been a challenge to go find good deals.
Yes, and the biggest deals we're finding right now are Dollar Generals because Dollar Generals are trading at all-time
High cap rates.
high cap rates, low prices, and we have never been able to buy a
Yeah.
Dollar General in the mid to high eight caps, and we've
Yeah.
we've had multiple ones.
Yeah. In the last restaurant retail that we did purchase was the Vortex restaurants. Right. So those are the last retail restaurants that we purchased.
Right, right,
Um,
and the Vortex it's a specialty local brand it's gonna be around for a long time. In fact,
yes,
we
this
still
is
need
going to
to
be
go
around for.
we still need
Yeah.
to go have some hamburgers. So anybody who wants to come have a hamburger with me at Vortex, you could take me up on this invitation because you're
Yeah.
watching this video and you've seen my invitation. So take me up on it, please.
Okay, so let's talk about our portfolio and how things are performing. So overall, right now we have 16 retail deals that we currently own and operate. Most of these they're a mix between this triple net and double net structure. When we look at our end of quarter reports, we send those out on the 20th of every month. Our double net lease deals, sometimes we have things we're doing in there, whether it's we have to be the ones that clean the parking lot, or we have to do the landscaping, or we're responsible for a roof here and there. We have those costs from a double net standpoint. The triple net is truly we don't have any costs associated with operating those. So those are the two types of deals that we're holding right now. We still have all the same brands. We're looking at Zaxby's, Dollar General, Applebee's, and then we have our just a few of like a single Taco John's, the Vortex locations, and in our Family Dollar.
Right. A DQ. We also have a DQ.
Yeah, so that's what our current portfolio looks like. We're seeing consistent payments across everything that we operate. Everything is still a top performer. Going back to Placer, talking on how are they performing from a foot traffic standpoint. So things are performing well. So overall, we feel like our retail properties, based on the information we have from them, are doing very well.
Yes. And
So let's go through. We can talk about like the distribution part. That's always the fun part.
right. So everything's distributing except
Yeah.
for two properties, and one property actually does have a distribution accrued, and we have cash in the bank, but we're just not distributing right now because we'll probably be looking at some type of opportunity around a new tenant for that one.
Yeah.
And so that's our
So-
Appleby Sumter property.
Yeah. So if we look at our 16 deals, 14 of our deals exceeded their preferred return goal for the fourth quarter and for the year. And we look at how we calculate that. We always use a metric at Greenleaf called our operating return on assets. So we're trying to get to a kind of finite number that is easy to compare all deals and say exactly how did this perform. To give a rundown of kind of just some basic math on what operating return on assets are. If you were to buy an asset, say you bought a restaurant for $1 million and you had some debt, and let's say you put $300,000 down to buy that and you got a $700,000 loan, if you're going to earn 6% on your money, that's $18,000 a year is what you would need to earn. Well, $18,000 divided by a $1 million asset would be your 0.18% that you need to earn. So when we look at our aura ratio, that is what we're getting. It's going to be 1.8% as a target. And if you divide that by each quarter, that's how you know what do I need to earn this quarter based on my asset value to meet my preferred return. So when we boil it down, that number essentially accounts for, after you receive your income from a deal, your operating costs, controllable, non-controllable, interest, principal payments, all of those costs, it's like, what's your net number? So our net number for our portfolio as a whole was right around 8.1% for the year, and really our annualized end of fourth quarter number. If we include our debt paydowns, that brought us up to 11.9% for the year. So roughly 12% was our yield that we were able to generate. 8% is distributed, and the other really 3.9%, 3.8% goes to principal paydown. So overall, we feel like it's a strong performer from a cash distribution standpoint. All of our deals are paying out some form of profit sharing of those 14 that we talked about. And then we have 2 deals that we'll go through and just explain, like, okay, what has happened with those and why did they not hit that above the preferred return? Why did they not get into the profit sharing spectrum? So we can touch base on those, but everything else has gone very well. We're seeing good payments. We're seeing occupancy. We're seeing good placer data, and the whole portfolio is working well.
So we get the standard retail checks. Everybody's getting their every property except for 2 are getting their retail quarterly distributions this quarter.
Yeah.
And
So let's go into the 2 that didn't hit their full profit distribution. The first one was our Dollar General in Sevierville. So this is when we have a double net lease. And on this one, it is one of the busiest Dollar Generals in the country. It's top 99%. So you look at 18,000 locations, this is one of the busiest ones that they have. But in the fourth quarter, it is a double net lease. And we had some plumbing repairs that we had to do that ended up being our responsibility to get done.
And it's even worse than that because this was, they actually built it with this plumbing problem that we would have never known unless it actually caused a problem. So some plumber decided many years ago when they built this place to put something called a double Y inside the connecting the toilets, and evidently a double Y is not to code. And so we actually had to dig it up and replace it, and it's underneath the floor. So we had to actually
we get out the big concrete saw. You've never seen that happen?
Yes.
It's definitely noisy and dusty.
But
essentially, you cut out the foundation of the floor
and dig
up the dirt, and replace the pipe.
And so it was an unexpected expense, very disappointing expense for me because I don't like those expenses. So we did shop around. I did find, we had multiple estimates, of course, and I did find the most competent and lowest price estimate. So we did it for the best value possible. And so that's why the distributions for DG Sevierville are not going to be made this quarter.
Yeah, so that was, one instance where we had an item like that does fall on our responsibility as the owner on those assets. So that one hit us for that one. That's the first time we've ever had something like that on any one of our retail locations.
Yes, it was essentially a building defect that.
Yeah.
Inspector, I don't know how an inspector would actually ever know that.
It kind of, every time we do a deal, we learn something. It's like, okay, we add this to our inspection checklist. When we're looking at multifamily apartments, a lot of times we'd want to know what type of pipes they have, because you can tell, like, hey, those are going to be bad or not bad.
Galvanized pipes, galvanized water
remember
pipes.
that? And it's like
or polybutylene.
Polybutylene pipes. But this is like, we could have ran cameras through the toilets. Maybe that's something we'll add to our checklist. We have our inspector go out there and do it. Like, hey, just run a quick camera, and we'll see. Because I'm sure
look for connection points.
A lot of times when you're looking at these bigger retail multi-site brands, they're using the same builder for 25, 50 of them per year.
Yes.
So as you kind of learn, like that little thing right there. So we'll add that to our checklist on the inspections, but definitely wasn't exciting. That kind of hurt us in the fourth quarter on that, but we don't see anything holding us back from continuing to perform going into 2025.
And quite frankly, when we fix these and we are interacting with the Dollar General, I call it the bureaucracy, we're building a good rapport with Dollar General. We're becoming a good steward of Dollar General and their stores, and we're developing a good relationship with Dollar General. So we're one of Dollar General's known landlords. They like us. We do what they ask us to do, and we live up to all of our obligations. And so we built a lot of credibility with them too.
Okay, our next one that it wasn't a physical repair issue, but it was on the debt front. So our Applebee's deal that we have in Seneca, it's one of the top performing Applebee's.
I think it's
in the
one
country.
Of the top. Well, in the state, I think it's like the top 2 or the number 2 or top 3 performer in the state of South Carolina.
Top 74% nationally, 90% in South Carolina. So it is a very strong performer. It's in a great location. Our debt on this deal did basically come up for expiration, came up for renewal. It expired. However you want to look at that. But our interest rate was at 3.7% going into the fourth quarter. And then November comes along and we're now at 6.75%.
Yeah, so it went up 300 points. So it's 3.75 to 6.75. That's a big hit. And so then of course, our interest expense goes up every month, every quarter. And so
Yeah.
then our distributions are going to go down because of that.
Yeah. So we were just in own the position we owned it at with the debt we had. It was making about 20% above our pref target on that deal. So it was making its quarterly pref. So it was making profit distributions and performing very well. Once things hit 6.75% on the debt, that brought us below our targeted preferred return threshold. So our options at that point are wait and see if we can find another loan at some point in time if interest rates come down. That's kind of a wait and see type strategy. Or the other option, and I guess we should say, I mean, we did work through the refinance on this thing so we can get our rate locked, even though it's not
and
great.
We found a good refinance partner too during this whole process. And so we now have a debt platform, which is pretty amazing, where we could actually send our deal out to a nationwide or a national audience and say, hey, would you be interested in building on this or bidding on it? And we made a lot of new lending friends on that. So that was pretty fantastic.
That's been helpful. So, things happen and we're always learning. We're continuing to improve and figure out what else we can do. So we took that out through a national debt platform to see what are the other options we can get on replacing our note that we do have on this location.
And we pretty much shopped this around forever, and we got the best interest rate that we were ever going to get.
Yeah.
So we were quoted anywhere from 6.75 to actually high sevens, and so we had quotes all over the board for this one.
So 6.75, definitely a lot higher than where we were at.
But
the best we could get right now.
Yeah.
So our options were really to hold this at the 6.75, not make our full pref distributions, and see if we can wait to a point in time when interest rates are lower. We're not super excited about having our only card be let's wait and see what happens. So the other option is that we take the deal out to the market and see if we can get some offers on it. We're still in a very good position on it. We mentioned it before, cap rates have not really moved that much. So it's not like we're selling something at a loss. Cap rates really haven't changed that much. Yeah.
It's not a fire sale.
And especially with it being such a strong location for Applebee's. Everyone else has placer data too. They can see that these strong performing locations are clearly going to be lower risk than a weak performing location. All the stores that are shut down in retail, they're shutting down stores that don't perform well, stores that don't make money. If the store is performing well and it's making money, most of the time that store's kept open and working. So that's where we stand on that one. So that's 14 that are doing great, hitting profits, and then 2 that one is a short-term change, right, where plumbing repairs were made this quarter, so we'll be back on track in the first quarter, and the other one is more stuck currently due to the higher interest rate that it has, making only partial distributions. Okay, so next, looking forward to 2025, really trying to figure out like what deals can we take advantage of and go find a problem to solve. Mostly what we're looking at right now is there reusable retail that we can get into and do something with to reposition something? Our strategy 2-3 years ago was really got into the like, let's buy a shorter term lease and get it extended and place debt along with that. And now it's like, okay, are there opportunities where we can take advantage of something that's vacant and do something there? Or are there brands that are performing well that are at higher cap rates that we can buy? And that's our Dollar General purchases.
And we did this with Zaxby's 5 years ago. And so all these Zaxby's we bought at the 7.5 cap are now trading in the 6s. And so we've proven that model. And so Zaxby's is no longer a
we would love to buy some more, but the cap rates are
too low for us.
Yeah, even those, we look at cap rates in general, some brand cap rates, some went up some, but some are just stayed really low and they're almost below interest rates. So those aren't a great acquisition target for us right now, but we're keeping looking at them and see what we can find.
Yes. Well, cool.
Okay. All right. Well, that is our fourth quarter update for retail. Thanks for tuning in and watching.
And we have a new deal coming out too.
We do have a new deal that we're going to get out there.
Yeah. So we just released our Dollar General Sylvania deal, which was released last week. and we're fundraising for that right now. It's a remarkable Dollar General, one of the top performers in the market. It's going to pay investors right now, conservative estimates about a 12% IRR, and we're fundraising for that right now.
Yeah.
If you're interested, let us know.
We'll have more details too. I mean, all of our end of quarter stuff goes out on the 20th. So if you're on our investor list, you'll get all of our end of quarter updates on the 20th. That's when everything goes. All the stuff hits your investor portal as well at that time. And yeah, if you have any other questions, please let us know. Thanks for tuning in. Hope this was helpful on our fourth quarter retail outlook. And we're excited for 2025. So we can go find some unique stuff to tackle. Thanks.
Thanks.